How's it going, everybody? Welcome back to the channel. My name is Jay, and today we're talking about DIVO. You may remember them from the 1980s and their hit single, Whip It. Wait, no. Sorry, wrong DIVO. Apparently the DIVO I'm going to talk about today is ticker symbol DIVO, which is the Amplify Capital Wealth Planning Enhanced Dividend Income ETF. That just rolls right off the tongue, doesn't it? And while DIVO the band only had one hit back in the 1980s, DIVO the ETF provides its investors with not one, but two sources of income. The first source of income from the DIVO ETF is dividends from the dividend stocks it holds. And the second source of income from the DIVO ETF is the premiums from covered calls that it writes against those dividend stocks it holds. So we're going to take a closer look at the DIVO ETF and how it stacks up against the other income ETFs it competes with. But first, if you can go to that thumbs up right below this video and whip it real good for me, I promise I'll stop making dumb jokes about DIVO the 80s band. Okay, so now that you've all liked this video to prevent me from telling any more stupid jokes, let's get into the DIVO ETF. As we already stated, the DIVO ETF is an income-focused ETF that provides income through both dividends and covered call premiums. And unlike some of the other income ETFs we've looked at, DIVO is a professionally managed ETF, or an actively managed ETF. That means it's got some fund managers at the helm making the strategy, making all the decisions, and making all the trades in this ETF. It's not passively managed, sticking to some index like we've seen with many others. The goals for the DIVO ETF, as stated blatantly and bluntly right on their webpage, are first, its primary goal is to provide current income to its investors. And they come right out and say, capital appreciation is only a secondary goal. So if you're sitting there thinking, well, this DIVO ETF is probably just like all the other income ETFs, all the other covered call ETFs you've done videos on, you'd be wrong. And there are some very important differences in how the DIVO ETF works versus how the other dividend and covered call income ETFs work that we've looked at previously. First and foremost, the biggest difference you need to be aware of is the DIVO ETF only holds a selection of 20 to 25 stocks as part of its holdings. If you contrast this against dividend ETFs like my personal favorite SCHD, which holds 100 different dividend stocks, or even VYM from Vanguard, which holds 440 dividend stocks, you can see DIVO is going to lack a lot of the diversification that is provided in those other ETFs. Even a strict covered call ETF like QYLD still holds shares in 100 different companies as part of its ETF holdings. So DIVO isn't very well diversified, it's really concentrated in the 20 to 25 stocks that it holds. And if you remember back to this video, which I did on the SCHD ETF, you'll remember that the SCHD ETF from Charles Schwab had a very well-defined selection criteria for the stocks it held and how and when it would go about replacing any of those stocks. All you really get from the DIVO ETF are that the fund managers are going to select 20 to 25 stocks from the S&P 500 that they feel best make up the fund strategy. And they could decide to buy, sell, or change up any of those holdings at any time as they see fit. So what stocks does the DIVO ETF hold? Here's the listing of the 24 different stocks that the DIVO ETF currently holds. And honestly, it's not a bad selection of stocks. A lot of the names in here are dividend stocks that any dividend investor would be happy to hold for the long term. So they all seem to be very high quality dividend paying stocks. They're not doing anything like adding some crappy stocks that have a really high yield just so they can boost up the overall yield on the ETF. What they're adding in here is pretty quality, and there's not much I can find to complain about with the current selection. You can even see the largest current holding is United Health Group. It only makes up 5.63% of the ETF. So while it only holds a small number of stocks, it does try to diversify across those 20 to 25 stocks so that not any one stock is too heavily weighted out of the basket it holds. The next big difference between DIVO and the rest of the income ETFs and dividend ETFs we've looked at comes from the second way it provides income to its investors, writing covered calls against its holdings. Yes, DIVO writes covered calls against the stocks it holds, but it's not a systematic approach. If you remember an ETF like QYLD, QYLD holds a basket of stocks that make up the NASDAQ 100 index, and then it writes monthly covered calls against the NASDAQ 100 index. It writes at the money calls with a 1-month expiration date, and it does this every month. DIVO? Not so rigid. Again, you're leaving it all in the hands of DIVO's fund managers. They're selecting when to write the covered calls, which covered calls to write, and which of the fund's holdings they're going to write covered calls against. They're not writing covered calls against all the stocks that the ETF currently holds. And you can see this in action if we go back to the list of the fund's holdings. We looked and saw the 24 different stocks that the ETF is currently holding, but down here at the bottom of the page, we can see the calls that it's currently written. It's written covered calls on Duke Energy, Apple, and Microsoft. So out of the 24 stocks it currently holds, it's only written the covered calls against 3 of them. So if you're going to hold the DIVO ETF from month to month or quarter to quarter, you're not going to be exactly sure which stocks the ETF holds and which stocks it's currently writing covered calls against, unless you're really checking in often and keeping up to date with all the changes in the holdings. Now, using this strategy of holding the dividend-paying stocks and writing covered calls against some of those dividend-paying stocks, the DIVO ETF seeks to provide a 2 to 3% gross yield from the dividends it's receiving from those stocks, and another 2 to 4% yield from the covered calls it's writing. So if you look at the current yield of the DIVO ETF, it's about 4.86% last time I checked. You can probably expect that to be split 50-50 between dividend income and covered call income. Another quick note is about taxes. On many of the covered call ETFs, such as QYLD or NUSI or JEPI or any of the others we've looked at, the tax situation gets kind of murky. With DIVO, it's pretty straightforward. They come right out in the prospectus and say that the vast majority of the income that is going to be produced by this ETF will be taxed as ordinary income. Now, with all that said, how can we expect the DIVO ETF to perform? If we compare it to a straight dividend ETF like SCHD, over the last 36 months, DIVO has returned 49.4% overall. SCHD has an overall return of just over 64%. If we compare it to a covered call ETF such as QYLD, over that same time frame, DIVO has returned 49.4%, while QYLD has only returned a total of 26.1%. If we look at just the income generated by those ETFs, over that same time frame on a $10,000 investment, DIVO would have made you $3,475 compared to $1,870 from SCHD and $6,094 from QYLD. So while DIVO states that its primary focus is to generate income and capital appreciation is only a secondary focus, you can see it does a pretty good job at threading the needle between something like SCHD and QYLD, where SCHD will give you a lot more growth for a dividend ETF, and where QYLD is almost a 100% income play. And for as actively managed as DIVO is, you've seen how we're leaving almost everything in the strategy up into the hands of the fund manager's whims. It only carries an expense ratio of 0.55%. And that's really not too bad for something that is this actively managed. It doesn't compare to the 0.03% of SCHD, but it is lower than the 0.65% from QYLD, which is much more passively managed. So all things considered, DIVO looks like it could be a pretty solid choice for your dividend or income portfolio. But is it one of the 4 ETFs that I think make up the best income ETF portfolio? For that, you'll have to check out this video right over here. Thanks for watching, and I hope to see you there.